Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy. Plus, global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Hi, everyone. Welcome to the Bloomberg Businessweek Weekend podcast. Well, our backdrop this week, a special program as we bring you highlights from our coverage of the annual Milken Institute Global Conference held in Beverly Hills, California. It's now in its 28th year. Tim is out this week, but with me in his place is Bloomberg TV anchor Romaine Bostick.
Yeah, and the Milken Global Conference is a gathering of individuals with the capital, power, and influence to change the world. So for the next 2 hours, we're going to speak with some of those who attended and who participated in panels on perhaps the biggest talks of the town, global trade and tariffs. And then we get to the flip side, where investors are finding opportunities, everything from private credit to artificial intelligence.
Yeah, I'll have to say, Romaine, it felt pretty optimistic, but the tariff word came into a lot of conversations. All right, everybody, we were also there, keep in mind, just ahead of the Federal Reserve's decision to leave rates unchanged yet again, even as President Trump strongly urges Fed Chair Jay Powell and company to lower interest rates. For the latest economic news and all about the Fed decision, head over to Bloomberg.com or head to the Bloomberg terminal.
And we had a lot of great conversations, but one of the big highlights was a conversation about the impact of tariffs on the global markets and how to manage that volatility. That conversation was with one of the biggest leaders in investment management, PIMCO. It manages over $2 trillion in assets, and we caught up with the CEO, Manny Roman.
I think people had made the assumption that there'd be a very quick resolution to the tariff question. And the reality is there's a lot we don't know, but that tariffs are going to be high and that we're going to have to deal with it for a long time. And that we'll need to readjust our thinking, both in terms of economic growth, but also inflation.
Can you make that change now, meaning like when you have to factor in what economic growth will be, what the impact of tariffs will be, even though we don't know, how do you make that pivot now?
I think you do scenario analysis. The big three trading partners are China, Mexico, Canada. So you basically run simulation and say, if this happened, then this will be GDP. If this happened, this will be inflation. And acknowledge that we don't know what the end game is going to be. Mm-hmm. The only thing we can reasonably say is the overwhelming likelihood is you will have high tariff for the foreseeable future. And we'll have to deal with this.
Manny, once we know what the terms are, does some of the uncertainty go away and things settle down? But it's structurally a different financial dynamic potentially, depending on how high those tariffs are?
I think that's right, but I think a number of companies will have to re-engineer the supply chain and optimize the production costs and the transfer pricing based on what the tariff will be. And I think that changing supply chain may not be as easy as what you make it to be. For us, we look at a set of macro parameters and optimize our portfolio and decide what we think is attractive in terms of asset and buy them at the best possible price.
So what does that mean for investors? Do they just kind of stay put, waiting for everything to settle? Or are they starting to make those bets, assuming it is going to be very different? Tell us a little bit about what you are seeing in terms of flows and so on.
I think you've seen enormous volatility in the equity market, and somehow I would say we're surprised that the equity market has bounced back to the Liberation Day level, but you've seen clearly a move to cash. Our world, which is the bond world, has been pretty much unaffected. And my partner, Dan Iverson, has this say where you look at the yield on a portfolio of bonds, say 6%, 6.5%, it's a very good predictor of what your return will be over the next 5 years. So if you want to own bonds, you're going to make 6.5%, give or take, over the next 5 years. How you're going to get there, a lot of uncertainty.
Well, that's what I'm curious is about the volatility. And I mean, you're referring to your CIO. I mean, I saw an interview where you actually talked about how he was really embracing that volatility to a certain extent.
There's two components to it. What we like about volatility is the fact that it will provide investment opportunity and a source of alpha in terms of trading different part of the curve, but also different product, and to move away from the US and find opportunity in other part of the world. So you can always buy US asset, but you can also buy non-US asset as a way to get duration and hedge them back into dollar. So for example, we like Australian duration. Australia has a very robust economy. We like Australian bonds, but we hedge them back into dollars.
Yeah.
That's a way to add alpha to the portfolio.
How complicated is it to do that when there's also a ton of volatility in the FX space and no one seems to know where the dollars might be going?
You may wonder what the 2,000 people we have in Newport Beach do. That's what they do. We could deal with that. Just about, but we could deal with that.
Listen, U.S. Secretary of Treasury Scott Bessent obviously really kicking off Milken on Monday, and he talked about the importance of watching the 10-year. Do you agree in terms of U.S. Treasuries?
The cost of borrowing is very important, and I think I will answer this in twofold. One, the US dollar as a reserve currency is really important, and the 10-year bond is in a way the barometer for the financial health of the world economy. So it is really important. Now, I would say you look at the whole yield curve. You look at the short end, the 10-year, the 30-year. You think also about credit spread. They're very tight. And you think about all of these parameters and try to assess what's to come and how you're going to deal with it.
Manny, one thing I'm curious about, and bringing up Secretary Bessent, what is the voice that you listen to most in trying to determine ultimately what happens in the U.S., especially when it comes to its financial system? It's been the place, the world's safe haven, right?
And it will remain the place of safe haven.
You're so sure. Why?
Well, think about it. The US dollar is the reserve currency, but it's also the most liquid treasury market in the world by an enormous factor. And yes, you can make a reasonable argument that the dollar is slightly expensive and that you may want to diversify from the dollar to other currency. But it does not mean that the dollar loses its status. And I think it's very important to keep that in mind. There's no other reserve currency. There's no other place to move trillions and trillions of dollars away from the dollar. And it is what it is.
Do you have faith in the Treasury Secretary to do the right thing, or at least get the president's ear on doing the right thing? Because he has said some things in regards to the Fed, the Treasury Secretary even. So I'm just curious, do you have faith?
I think the wonderful thing about financial markets is that they're efficient. And
so they'll tell them.
And that the market reacts to policy.
Yeah.
And when the market doesn't like either policies or a tweet, the market reacts in such a way that people need to adjust the course of action. The market wants the Fed to be independent, and I think has voted very strongly about that. And I think that dictates some of the choices and some of the noise around all of this. And, it's a good thing. Markets are there to reflect supply and demand and also reaction to events in the world.
And we saw that play out in a big way in April. One side of that, though, but basically to your comments about their kind of this being the most liquid market, this is kind of the reserve currency, and that's not going to end. Will it lessen to a degree? Because when we look at our treasury market and we think about how many global investors hold our bonds, all the rumors that maybe certain nations might be willing to weaponize their holdings if the dispute with the U.S. over trade escalates, does that concern you?
There's no free lunch. The reason why people own U.S. dollar is because they like to own U.S. dollar asset. There is a very strong case for American exceptionalism, the fact that the financial systems are very liquid and very well run, and that if you, for example, a Japanese investor where there's about $1 trillion of U.S. debt held by a Japanese institution, it's a good place to be, even hedged back in yen. And I think that's really an important fact to remember in terms of the flow of fund and who needs to put money where.
Is the Treasury market healthy right now?
Totally.
You weren't concerned at all about what transpired that first week of April about a potential gum up in the system or that mismatch between buyers and sellers?
No, on the contrary, I think we've seen very liquid market, both in Treasury and in credit. And to be honest, markets have been remarkably well behaved. Yeah. We had a couple of difficult days during COVID before the Fed intervened, but it's been very smooth sailing since. And the markets offer plenty of opportunity to change your mind. One of the good contributions have been ETF, where ETF have allowed people like us to do portfolio trade, to rebalance our book, and to use this liquidity to move assets around. And I would really emphasize this: the markets are quite liquid.
I promise not all my questions are pessimistic, but I do have one more. With regard, you had a market that had to deal with the trade issues. That hasn't been resolved, but they certainly made some degree of peace with where we are. There's now a big budget battle that's about to take place in Washington. And I do wonder, as the leader of the biggest bond investor out there, is there concern that our fiscal deficit and the potential remedies that are being discussed in Congress could exacerbate the situation in the fixed income market?
That's the wonder of being the reserve currency. Everything else being equal, you can run a slightly higher deficit than you would otherwise. And I think that, of course, people will look at the amount of deficit and it is overwhelmingly likely that the deficit is not going to get reduced. But once again, would you rather own very high quality assets in the US, or would you rather own bonds in Southern Europe? You can decide which one you would rather own. That's the reality. The reality is you need to invest somewhere.
So you're not worried about, it's a lot of debt, the fiscal situation. It's been a lot of debt for a long time, but now we're at levels we haven't seen. Should we just accept it?
No, I think I would reply with a quote that I heard Janet Yellen give in a private conversation. Yeah. She said, all we can say is it's not a problem until it becomes a problem. And so it's a deeper meaning maybe that it appears. Like there's a tipping point, which is very hard to guess, where all of a sudden, either because the issuer loses credibility or because the policy doesn't make sense to market participants, people all of a sudden don't want to be the marginal buyer.
Our thanks to PIMCO CEO Manny Roman.
Coming up, much more from Milken 2025. This is Bloomberg.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
I'm Carol Massar, along with Romaine Bostic, in for Tim this week. With a special edition of the weekend edition of Bloomberg Business Week, we are bringing you all of the highlights from our coverage of the 28th Annual Milken Institute Global Conference in Beverly Hills. Gotta say, a lot of energy, a lot of people were here.
A big theme this week, cautious optimism. Robin Grew is Chief Executive Officer at Man Group, one of the world's largest publicly traded hedge fund companies, managing over $168 billion in client assets. She says, despite recent market volatility, there's still plenty of investment opportunity.
Volatility is a place where we need to lean in to do more. We are in volatile markets. We're not going back to a benign market environment. And so in that space, we have to be prepared to create diversified content and capability that's able to navigate these markets to provide outsized returns or alpha returns to our investors.
How do you do that, though? Because when you look at the strategies that Man Group has, a lot of systematic strategies, a lot of trend-following strategies that we've seen over the last few weeks and months does not necessarily perform optimally when there is so much misdirection going on in the market.
Totally. And they're not supposed to. I think that's the thing that we need to be mindful of. In a diversified portfolio, you're going to have assets and capabilities and strategies that do perform. And we've seen that in credit. We've seen it in great active equity management. We've seen it in multi-strat. But you don't see it in trend because that whipsawing, whiplashing behavior doesn't work for it. But that's why when clients are talking to us about how do they position their portfolios, they're looking at the things that will operate in markets as we're seeing today. And they're also thinking about defensive alpha. And what we do know, and what we've had history around, is that when you have decades of experience in momentum and trend, they operate well when this volatility slows down, and then you can find the trends again.
Do you expect that volatility to slow down anytime soon?
I think that volatility is going to be here for some time. It's whether the volatility is accompanied by whiplash behavior. And that's what the markets are looking for, that consistency, something that is predictable and capable of being predicted. But there's no doubt that the opportunity set across markets are really interesting right now. 100 days ago, you might not have thought about Europe as a growth opportunity. We're looking at Asia with a very different set of lenses. We're seeing real opportunities for active and alternative investments. And it's about staying calm through this time as well. But volatility, will it be here for some time? I think so. Dispersion? Yep, I think so. But whiplash? Let's hope not forever.
I don't know if you got a chance to hear what Scott Bessent had to say at one of the Milken panels here, but there was a really interesting moment where he really turned to the audience and looked straight at them and said, we're trying to make everything more appealing for you, meaning for the investors out there that are in this room. Do you find any comfort in hearing those words out of Scott Bessent?
Absolutely. We want this biggest, deepest capital market to function really, really well. We just also put to work by our clients to go and seek out alpha wherever that may be, that outperformance across all markets. It's why we trade 800 plus markets in the world. That's our job to do that. And we do that for real individuals who have saved all their lives, who have put into their pension pots, be it their 401ks or their IRAs. But yes, I think it's a tremendous statement that we have Scott Bessent talking to us about actually being supportive of markets. I think that's a great thing.
Is that too little too late? This is a room full of people from around the world. And you know there's been a reallocation of capital, or at least a rethink of whether to reallocate capital away from the U.S. to Europe, for example, or even to other parts of the world.
Too little, too late? I don't think so. I think we all look to the quality of the US as an investable space. Again, it's the opportunity set that's out there. Is it a bad thing that there's competition? Is this a bad thing that there's growth in Europe or an opportunity set in Asia that's opening up? I don't think so. In the same way as I don't think it's a bad thing that we're seeing the opportunities in private credit open up. So I think there's plenty for us to keep our very detailed focus on. But no, I don't think it's too little too late.
How do you keep your team, the folks who work under you, not just motivated, but to get them to understand what the long-term goal is in an environment where we are so focused on these minute-by-minute short-term disruptions?
I think the reality is you have to have confidence in the strategies you're running. And you have to know that those strategies are performing the way they should do in the market environments you're in. So you keep that focus. At Man Group, if we have strategies that aren't working in a period of time, I don't have to go onto the floor and make people feel more unhappy. They're doing that themselves. So for what we do, it's about being sure that we're doing the best we can do. We continue to be at the cutting edge, entrepreneurially, of content and product and capability, that we deliver that to our clients, that we deliver more than just funds or products even to clients, that we're delivering the decades of experience we have in AI or technology, or we're delivering the nearly 20 years of experience we have in our partnership with the Oxford Mann Institute at Oxford University. It's about keeping people focused on the day job. It's about staying calm.
You mentioned AI, and of course, Man Group is probably one of the early adopters, at least in the finance space, of AI. And I think we spoke about this at Bloomberg Invest a few months ago. Does that become more critical in times like this, having those types of capabilities, or is it potentially a liability? Because you're effectively talking about, I don't know, something that's, I don't want to say it's predetermined, but certainly there's a roadmap that's put out when it comes to these models.
Listen, I think AI is a tool. We talked about it before. It is a great capability. When I think about generative AI, when I think about AI agents, it's about deploying those. It means we can be better, faster, smarter. It doesn't replace the human being, and it doesn't mean that you need to ignore the risks that are incumbent in these capabilities too. But I think that tech is part and parcel of what the future looks like. Undoubtedly. AI part of that? Undoubtedly. You don't have to look very far in this conference to see just the power and the capability of these future technologies.
And you think the investment in that writ large, not just in Man Group, investment in that AI tech, that hasn't been disrupted at all? There hasn't been a rethink on that longer-term investment opportunity?
Not for us. We continue to think that AI, and we continue to think that this is both being consumed within Man Group and within the work that we do, but the broader reach out into other industries and other spaces is going to be, I think, transformational.
You've been on the job for a while now, so you're not new, you're more of a veteran now. And you're a veteran at a time where this has to be one of the more challenging times to be a corporate leader, certainly of a financial company. And I am curious as to what you want to do to grow Man Group, knowing that the world order that you came into, if not over, is certainly being reshaped.
I think listen, it's a privilege to sit in the seats we do. And I've been talking to clients non-stop, really, for the last 100 days or so. And that privilege is something we shouldn't forget. Mm-hmm. You get a front row seat into what's happening in the world doing the jobs we do. And so my job, how has it changed in the last 100 days? It hasn't really. It's still about doing the right thing by clients. It's still about sticking to the strategy we have. It's still about creating diversified, orthogonal, uncorrelated content so our clients can benefit and can return value to their underlying savers and pensioners.
Our thanks to Man Group CEO Robin Grew.
All right, well, also top of mind this week was access to private credit given market uncertainty. I got to say, Romain, private credit, always a big topic here.
The companies that get private credit loans are looking increasingly wobbly, and banks are among those that could eventually be on the hook for those losses. For his take on the environment, we spoke to Stephen Tannenbaum. Steve is Golden Tree Asset Management founder and chief investment officer, overseeing almost $57 billion for institutional investors.
So right now, spreads, HYG, which is the ETF, is pretty much unchanged. Yet the expectations for the economy have shifted down. So right now, the market doesn't seem to believe that there's an issue, but predictions and the environment certainly doesn't reflect that.
So round trip, are we back where we want to be, or are we back at a place that's very different from where we started?
So I think the real issue is this 2022, where the concerns about a recession are overblown, and we're going to play through this, very much the resilience that Treasury Secretary Besson talked about, or are we in for something that's more turbulent, and that the expectations that the economy is slowing is actually going to be realized, in which case spreads do not reflect that.
When you look at how much spreads did increase in early April and the narrowing that's occurred since, similar to the rebound that we see in public equity markets here, is that in sync?
They certainly are complementary. There's been more dispersion in the equity market, and particularly in mid and small cap, than what we've seen in the credit market, which has really been pretty much technically, recovered pretty much to the levels that they were before.
When you're looking around right now and you see what's already on your portfolio, but also new opportunities, do you have some sort of transparent price discovery right now, or are things kind of muddy?
In terms of the stuff we're doing now, there's always idiosyncratic. I've been a portfolio manager for 35 years. There's always something to do. But in terms of is the market that interesting? There's no FOMO of not participating. But we're going to get more evidence about how things are in the next 4 to 8 weeks. And I'd rather be tighter with more confidence, or believe that the market reflects the uncertainty.
So you don't want excitement, you want boring.
No. I'd rather have a lower price with excitement or a higher price with boredom. Yes.
Well said.
Yeah.
Are you looking to do capital raises because you anticipate there's more opportunities to come once things settle down?
We're pretty good with capital, so we have our catcher's mitt, and also we're pitching some deals. One of the things about this current environment is there's the M&A and some of the asset sales that private equity was expecting isn't coming realized. There's a wider gap between buyers and sellers. So one way to return capital to LPs is through dividend deals. So we want to facilitate that.
I am also curious, we have seen spikes in terms of credit spreads widening. I think about the last month, the moments of stress here. Do you think that's it for this year? I mean, the volatility has been immense, and I understand what you're saying, the difference between the public and the private markets, and I'm curious which one is right at this point.
So I remember during the UBS Credit Suisse, and it lasted for maybe a day. And there was a good reason, because the dynamics of that deal that were onerous to the Credit Suisse junior debt holders, that you could extrapolate that. And it turned out, because the Swiss regulator is different than the rest of Europe, you could pretty much isolate that. I think it's very different in the US. It's still developing. And then there's the tariffs with our allies and who we have very healthy relationships. And there's the more developing relationship with China that is unclear. And those are two different discussions. And how they turn out, we're going to see.
That was Steve Tannenbaum, founder, managing partner, and CIO at Golden Tree Asset Management.
Still ahead on Bloomberg Businessweek, FCC Chairman Brendan Carr on incorporating private investments to grow wireless communication across the United States. This is Bloomberg Businessweek.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Carol Massar along with Romaine Bostick. We've got a special edition this week of the weekend edition of Bloomberg Businessweek. We are highlighting interviews from this past week's Milken Institute Global Conference, held, as it always is, every year for 28 years in Beverly Hills, California.
And while tariffs and market volatility were certainly top of mind this week at Milken, technological advances and the U.S. dominance in them, well, that also featured prominently among the discussions.
They certainly did, with thoughts on how the Trump administration is working toward generating $80 billion in government revenue and helping the U.S. better compete with China. We caught up with FCC Chair Brendan Carr.
President Trump has been very clear. He wants to unleash America's private sector to build again. If you look back the last 4 years, so many infrastructure projects got bogged down in reams of red tape. We saw it with his $42 billion internet infrastructure plan that went nowhere. And so he directed us to deregulate. In fact, we've engaged in the most massive deregulation effort at the FCC that we've ever done. It's underway right now. We've closed and looking to close 2,000 dockets that have been open. But probably the most important thing we can do for the economy right now is spectrum. These are the airways that your smartphones use. We made a lot of progress on that during the first Trump administration. We fell behind a little bit during Biden. We need to move hundreds of megahertz out in the marketplace. That's actually deflationary. It's going to drive down prices for consumers. And it's going to be pro-competitive, too.
Those dockets, I mean, what actually accelerated that? What was the outcome?
Yeah, so right now we're targeting all of those. We're seeking comment on it. We've already closed over 100 dockets. We're doing a massive deregulation initiative. And permitting reform is so key. You know, we have these rules on the books that force broadband providers like AT&T to invest billions of dollars in old copper line networks. But we're taking a fresh look at that so they can move that investment over to high-speed IP networks. So it's effectively moving billions of dollars of capital into new networks. These are some of the economic agendas that we're running at the agency.
So what's the timeline on all of this? It's a lot to get through, but what is the timeline that you guys are looking at?
It is. Our direction is to move on Trump speed, so we're moving very quickly. The first 100 days already, we've taken action across many of these fronts. Also, national security. We set up a new council on national security at the FCC. We're making sure that we're not vulnerable to threats that come from communist China, for instance. We're looking at making sure that people can make and manufacture things here in the U.S. as well. And so we're running a full economic agenda, and we're pretty proud of it.
What are you hearing from members of the telecom community about what they can do in terms of manufacturing here in the United States?
Yeah, there's a lot we can do. For instance, no piece of electronics can be used in the U.S. unless it's tested in a lab. But so far, 75% of those testings take place inside China. So we're looking at steps we can do to reshore a lot of that testing as well, and that'll help give U.S. manufacturers a boost.
How long would it take to do that?
You know, I think it can be pretty short order. We already have some of that testing here already, so we're taking steps to sort of further do it. But these are just, parts of the pieces we're running at the FCC. It's a really important agenda. Again, we've got to unleash America's private sector. They were held back too long by different red tapes and regulations. Permitting reform, again, as I mentioned, a lot of state and local regulations still slow down internet builds. There's a role for the FCC to step in there and help clear the way. But spectrum, permitting reform, deregulation, that's the driving agenda at the FCC. I think it's going to be great for the economy.
How unified is this approach from the administration? Is the FCC a part of that?
Yeah, for sure. Look, President Trump has put together just an all-star team, particularly this second administration. Everybody is fully aligned. They're executing the president's agenda. You mentioned AI. I mean, that's going to be the use case that's going to drive so many of these telecom networks. That's why we have to get more spectrum out there. That's why we have to make it easier to invest in these new high-speed networks. When you look at the data demands of AI, data generally is going up, but AI is going to increase through the roof.
Where do we stand, though, on spectrum? Because I've heard that before. Mm-hmm. What's out there, and even some of the spectrum that has been released over the last few years, there have been some concerns that they might be causing interference, particularly with some of the recent incidents that we had in aviation here. Can that sort of coexist altogether?
Yeah, look, thankfully President Trump has a playbook on this. In 2017, we had fallen far behind China. He stepped up and said, look, I want to lead in 5G, I want to lead in 6G. We cleared hundreds of megahertz of spectrum. We fell behind China. The reality is we are falling behind China right now. But we have the playbook. President Trump is going to step in. We're working right now. Chairman Ted Cruz in the Senate is working hard to get spectrum across the finish line. And we can put it in reconciliation. And that's going to help pay for a lot of the efforts that people want to do in there. It's going to be $80 billion or more to be raised if we start auctioning this spectrum off.
Chair Carr, what does this do for people who really don't have access when it comes to telecommunications, our rural areas? We've heard so much of this post-pandemic. Everyone has talked about helping these areas for a long time. How do you actually help those Americans?
Yeah, there's a couple things we're doing there. When we get more spectrum out, that will bring people across the digital divide. It'll give people more competitive options. But also, think about this new generation of low Earth orbit satellites, whether it's Starlink, Kuiper just started launching. There's other providers out there. When we bring that together as part of the solution, that's really the long-term key to bridging the digital divide in a cost-effective way.
Well, that's interesting that you bring up Elon Musk, Starlink, Doge. We know his certainly close relationship with the president. I mean, how much of the work you are doing is kind of focusing on his kind of technology?
Well, look, I think the space economy in general is probably one of our top 3 issues that we're doing at the FCC. We need to start moving much more quickly. It took, years to get the permits necessary for a lot of the communications for these satellites. We need to be doing that in a matter of days and weeks. But it's not just Starlink.
How do you do it safely, though? There is some concern about how many satellites are up in space at this point. We just did a big deep dive here at Bloomberg about concerns about satellites coming down. I mean, there is a process here. How do you do this safely?
Yeah, we feel comfortable. There's orbital debris mitigation rules that are in place. We license all the satellites at the end of the day. We feel very comfortable that we can still get thousands of more satellites out there. And again, the new trend is direct to people's cell phone. And that's something that's just emerging. In fact, we've given providers authority to go higher power from these LEO satellite systems to get even better direct-to-cell capabilities. So this is a really exciting area.
I want you to talk, though, particularly when it comes to the satellites in space. There's obviously a lot of competition between nations for that real estate, if you will, in the air. The U.S. obviously had the first mover advantage. China has been launching like crazy. India now trying to get into the mix. And we're seeing other countries, including in Latin America, also try to find space up there. Does this become a conflict at some point?
Look, I think this is going to be a very important geopolitical issue. As you know, China is trying to launch their own version of whether it's Starlink or Kuiper. And when they're able to pair Belt and Road with high-speed internet provided from satellites with their own CCP content moderation filters, that's a real threat going forward. And that's why it's so imperative that the FCC move quickly to allow U.S. providers, again, a full range of them, to launch, to compete, to provide coverage. And so that's what we're going to do with the agency.
Our thanks to FCC Chairman Brendan Carr.
Now, from investing in high-speed networks to leading the global race for energy independence and artificial intelligence dominance, it's another major goal for the Trump administration.
Michael Kratsios is Policy Director for the White House Office of Science and Technology. He says the administration is all in on energy and overall technological dominance.
Yes, it's something that the president is very focused on and something we as administration are committed to ensuring, as the president says, unquestioned and unchallenged global technological dominance. And that's going to require a lot of work from us, from R&D to dereg to adoption. So there's a ton we're working on. And as the president signed an executive order just a couple weeks ago to make sure that our K through 12 education system is geared to prepare our students for this AI future.
What's the runway for that? Because there's been a lot of talk about how much brain power, if you will, already exists, meaning so for the adults out there, and how many people we need to sort of train up, meaning the next generation of folks, to ensure that we have enough skilled people to take this forward.
The president realized that it's critically important that we prepare the next generation of Americans to wield and utilize these tools. So we began with this executive order on artificial intelligence in K through 12. and essentially is doing three things. I think the first thing and the most important thing is bringing together public-private partnerships to support AI education. It's something that we cannot do alone. We have great industry partners that care about helping here. We have great folks in philanthropy, great folks in government, and the K-12 system itself. The second, which is really exciting, is a presidential AI challenge. So we want to create in a sense, an Intel science fair or like a DOE science bowl, so a premier competition for AI that would ultimately end up in a event at the White House next year.
Yeah.
And lastly, you said we have to train Americans, reskill them, retrain them with the AI tools that they need to succeed in this economy. And we're working very closely with the Department of Labor to make that happen.
And just to be clear, so the president understands that and understands the importance of a government role in facilitating this, because when a lot of people talk about our leadership in the United States from a technological standpoint, they point back to a lot of those post-World War II programs that came out of the Defense Department and DARPA and other sort of government research facilities that fed into university research facilities and ultimately into the private sector. Is that the playbook?
Yeah, so what's very unique about the American innovation ecosystem is it's really three parts. It's one part academia, one part private sector, and one part government. And all of them kind of pass the torch from one another to drive innovation. So the federal government often funds early stage, basic, pre-competitive research. Universities make fundamental breakthroughs or discoveries. Those are ultimately taken up by the private sector and commercialized, and the government steps in to help create a regulatory environment for those new technologies to succeed and thrive. So we're going to continue to work on that effort and make sure that we have the best functioning innovation ecosystem in the world.
What needs to be changed when it comes to the regulatory environment? You've been on the record in the past saying that you thought that things were, there were too many barriers, if you will. What's on the agenda right now that this administration wants to do to lower or at least smooth out those regulations?
We really have to find and identify barriers which are inhibiting the proliferation of emerging technologies. We want to be flying supersonic again. We want commercial drone deliveries to be happening in the United States. We want self-driving vehicles on the road. We want AI-powered medical diagnostics. All of these things have been slowed down or hampered by a regulatory process which may be good intention, but it's just too slow. And we need to continue to lead the world on this, and doing this deregulation is a big piece of the Trump agenda.
Do you see us primarily in competition with China on that front?
Look, I mean, we're in competition with so many people around the world. Everyone wants to be a leader here, and obviously the PRC has made it very clear that they want to lead the world by 2030. Mm-hmm. The U.S. is in a very lucky position where we are the world leaders, so we need to continue to make sure we have an environment where we can maintain that leadership.
And university is going to be a critical part of that. Are they not? There's been a lot of discussions about the president's attacks on certain universities, about some of the brain drain that maybe we might see as a result of that. How do you reconcile that?
The most important thing about federally funded R&D we have to think about is it's not about spending a lot of money. If you spend a lot of money on the wrong things, it's worse than spending a little money on the right things. Mm-hmm. So we're making sure that the biggest priorities for the nation, things like leading in artificial intelligence, leading in quantum information science, that we continue to fund those areas and make sure that our universities are a big part of that agenda.
Tariffs. I have to ask you about tariffs. Your president has made it clear he's tariff man. They're here. They're coming. Does that have an impact, though, on what you're trying to do? Do you have to factor in maybe the extra costs to whether bring things in or reshore things?
What we're seeing is some of the greatest technology companies in America and around the world are coming and they're investing in the United States. As Secretary Besson said this morning, more investment has come into the United States in the last 100 days than it has in the 4 years under President Biden. So what we're doing is actually bringing these new technologies here in the U.S. You saw the TSMC announcement that's happening in Arizona, where we're going to be building leading-edge fabs here in the United States, and so many more great investments. So I think we're on a pathway to really make sure that we have the tools that we need to keep driving this AI leadership position.
That was Michael Kratsios, Policy Director for the White House Office of Science and Technology.
And that wraps up our first hour of the weekend edition of Bloomberg Businessweek from Bloomberg Radio. Coming up in the next 60 minutes, much more from Milken 2025. This is Bloomberg Businessweek. I'm Carol Massar, joined by Bloomberg TV anchor Romaine Bostic. Do stay with us. Today's top stories and global business headlines are coming up right now.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
Plenty ahead in our second hour of the weekend edition of Bloomberg Businessweek. Carol Massar here along with Bloomberg TV anchor Romaine Bostick, highlighting important and smart conversations from this week's Milken Institute Global Conference in Beverly Hills. We were there. There was a lot going on,
including a conversation with former Baltimore Mayor Stephanie Rawlings-Blake on housing affordability.
First up this hour, as we've mentioned, many of the discussions at the Milken Global Conference this week highlighted opportunities during uncertain times. One of those opportunities lies in global real estate and how market leaders are capitalizing on distressed assets and real estate debt amid tightening credit conditions.
Discussing investments in real estate and American exceptionalism are Deborah Cafaro, Chairman and CEO of Ventas, Justin Kennedy, Managing Partner and Co-founder of 3650 Capital, Andrew Smith, Managing Director of Bayview Asset Management, David Steinbach, Global Chief Investment Officer at Hines, and Barry Sternlicht, Chairman and CEO of Starwood Capital Group. They joined Carol for a panel from the Milken Global Conference. Here's Deborah kicking it off.
I still think the U.S. is the principal best investment in the world, and we're on sale now.
We're on sale now. So buy.
Yes.
David, what do you think?
Well, look, without question, the U.S. remains the largest economy in the world. I do think that a lot of things are getting reworked in the global economy. I think some themes are going to pick up in this session. And I think embedded in that are some deep opportunities, as well as some emerging risks.
Andrew?
Yeah, I would echo their optimism as well. I think that it is the largest economy in the world. We are a little bit on sale right now, but overall, I don't know where else you're going to go to get the diversity and safety of opportunities despite some of the noise we're seeing out there.
Boy, it sounds like American exceptionalism still exists. I'm just
Buy America. Yeah.
Yeah, I'm hoping Barry's going to say something different.
I'm counting on it.
I'm with the rest of the crew.
He's so shy,
Biggest, most efficient capital markets.
Yeah.
Biggest, most important market, energy independent. And let's call it, if we take the Secretary as his word, this will get fixed. So U.S. looks pretty good.
All right. What do you say, Barry?
I don't want to make anyone upset. Yes, we win by default, but that's not the way we should win. We should win because we're doing the right things and the world admires us and wants to invest here. So I think it's a little more complicated than that. We are the largest economy in the world for now.
Yeah.
I guarantee you China will pass us because they're quickly building bridges into all the countries that we have offended. We also have food independence, by the way. We used to have stable, quiet borders, but they're no longer here either. So we shouldn't take it for granted where we are. And we have a 37 trillion deficit on its way to 50 trillion. And that's going to require funding from the rest of the world. So don't be so complacent on our position in the world. The British had a pretty good run, so did the Holy Roman Empire. We had 100 years. And honestly, I look back, and I talk about this sometimes, if we don't fix our education system, the destiny of the United States is not good. And I saw this morning Abu Dhabi's introduced AI into schools. We have to actually get with the program. We can't rely on historic innovations that also came from immigrants that run all our great tech countries that we want in the country today. So you got to look in the future, not in the past. And I think we have a lot of challenges. We should win.
And I promised these guys I wasn't going to start macro, but the one thing that I think is interesting, and forgive me, and I can't remember who said this, but it's Donald Trump being the right question, he's just not the right answer. And Deborah, you're nodding.
Yes, I would point out and agree with a lot of what Barry's saying, but if you think about our global leadership position in biomedical research, for example, we're the envy of the world, there's almost $1 trillion in spend, and whatever the question is, cutting fundamental research that's going to cure Alzheimer's is essential and has a huge multiplier effect on the economy.
I think part of what we're saying, there's just a lot of noise that we don't know how to cut through, that the communication globally on what we're doing is not really there. So I think we all believe that the ultimate goals are ones that get us to the right place, but how many people do we offend along the way, and can we kind of reel it in enough to make a difference?
You live in a glass house. You have a $37 trillion deficit. The deficit will easily pass $2 trillion this year. Even in the Trump 2019 economy before the pandemic, he ran a $1 trillion deficit with a 3.8% unemployment rate. We were basically, as one of the money managers said, we were on sugar highs. We can have a 20-year plan. It doesn't have to be overnight, but we have to have a plan to have global confidence And it's both the revenue and the expense side. So it's not a foregone conclusion. We should win. I mean, we are by far the best at most everything we do here. And people envy this country. We have to continue to want them to envy. And the best and the brightest have to come here, and we have to let them in. So we want all these fabulous people here.
Just one question on tariffs. So is tariffs then the right strategy? Is it right, this pushback? I'm not saying the back and forth, but in general of saying terms have to be fairer.
I do think deals will get cut. It's going to be time. It's probably take more time than we probably appreciate. We're going to have to live with this in-between period of a lot of just uncertainties that businesses are pulling back to wait to see what plays out.
Right.
But I think even on the other side of this, it does feel like there will be more friction costs in the global business of trade. After you squeeze all the toothpaste out of the tube, it's really hard to put it all back in. Mm-hmm. And so I think we are going to be living in a world of more friction costs. And I think that, though, to me is a broader theme of deglobalization that we've been watching for several years now. This is simply deglobalization playing out. And this is going to be one of many things that investors are going to have to think about and navigate.
All right. Well, let me just ask you guys, are you optimistic in terms of when it comes to real estate investing?
Yeah, actually, for real estate.
Yeah.
Definitely.
You guys are pretty up. Are you optimistic?
Mixed.
I'll be the outlier here.
You're going to be the out.
Mixed.
Well, that's opportunity for you.
We think so, but it's at the same time a risk factor for the markets. We see a situation where real estate has really changed fundamentally across a number of very important hurdles that people have to think about in terms of their investment strategies in the current environment, particularly looking at the commodity part of the asset class. And maybe people up here may be in a little bit different place relative to specialization in Deborah's book and let's call it A++ targeting at Hines. As we look at the market, these types of strategies have been very successful. Mm-hmm. At the same time, the commodity part of a market has suffered a huge shift in demand. And demand.
What asset class are you referring to? All?
Industrial has had a shift in demand to the positive side. Multifamily is kind of a more complex picture that's really regionally guided. But both retail was really both retail and office, where we first saw, let's call it, the impacts of technology changing, let's call it the core utility of properties, that these are markets where we're been through 15 years of re-equilibration in retail, and we're just at the start of looking for equilibrium in the office markets on the commodity part of the asset class. Just a quarter mile away here on Avenue of the Stars, the highest rents, the highest occupancy ever seen. Same was true in Park Avenue in New York, yet downtown Los Angeles is having essentially an existential moment in terms of, are tenants able to pay rents or are rents able to be achieved that are at all accretive at any price for those assets. 1 year of rent on Century City buys you a building in downtown Los Angeles. And this is a very new place for the markets, and this is what we're concerned about. And that, the questions that this poses for, let's call it, traditional real estate strategies, we think are pretty significant.
So lots of dispersion. David, you want to?
Yeah, I was going to say, I also think, what's happening in the market is this dispersion, but what's compounding that, and I think investors need to be thinking about this in terms of the next couple of years, is new supply has really been cut off, right? Interest rates moved 500 basis points around the world, and the development does not pencil anymore. And so many projects around the world have been now stopped for now. Mm-hmm. And that, people forget how long it takes to build things. You just don't throw these things up. I mean, there's the planning, there's the consent, there's all the things that have to happen locally. Then you have to actually do the construction. And so I think that what we're going to see in this environment is right now is certainly a time to buy, not build. And there's some great opportunities on the buy side. But what people are not watching is the fact that we're not building anything. And that will drive even more rent growth for the best in class, and will become a big opportunity. So a thing I think investors miss, and this is a common, you just see this through cycles, is the market is now in a buy phase, and which is great. I think it's a great opportunity. But they're going to miss these early development signals that will start emerging because the best margins in development are early in the cycle, and they diminish as the cycle wears on. So that's this turning point there. We're not there yet, but I think it will be coming in the next 18 months, say.
I mean, I think most investors know the supply picture for real estate. I mean, if you're sophisticated, you know the multi-stack is going to drop 60%, the industrial stack's down 70%. Nobody in the right mind would build an office building unless it's a build-to-suit for a tenant today. Hotels are still trying to build, but cost of capital is so enormous that they're struggling to make the numbers work. The lending markets, which Justin is in, and I think Andrew also, I mean, they'll lend us money for office buildings at 400 or 500 over. We'll say, no, thank you. It's higher than, it's massive negative leverage on the debt side. But it is one of the most important premises of opportunistic investing in real estate is replacement cost. And you can buy most everything pretty cheap here, and with the land at zero. And it's just a question of what it's going to cost to keep the building, whatever it is, tenanted. But it is interesting to me. I started this new hotel brand, One Hotels in Baccarat, and we're not a commodity. And because of that, we're like 150, 170% of fair market share in every market we operate, and we're in like 15 or 20 markets now. It's happening in real estate too. People are running office buildings better. She's running her senior housing and assisted living and senior stuff better. Commoditization is leaving the table. And you have to do something better. It is really, really interesting today how you take real estate and make it not a commodity. And it's upping the game on all of the operators in the business to figure out how to do in your asset class to steal market share. Because there's plenty of occupancy. You just have to be different.
That was Barry Sternlicht, Chairman and CEO of Starwood, Deborah Cafaro, Chairman and CEO of Ventas, Justin Kennedy, Managing Partner and Co-founder of 3650 Capital, Andrew Smith, Managing Director at Bayview Asset Management, and David Steinbach, Global Chief Investment Officer at Hines. A panel discussion with Carol. The full panel discussion can be found at milkeninstitute.org.
Lots of stuff. Check out all the conversations from Milken as well. Hey, you're listening to Bloomberg Business Week. Coming up, more from Milken 2025 with a look at individual companies. This is Bloomberg.
This is the Bloomberg Business Week Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Carol Massar here alongside Romaine Bostic and for Tim Stenovec this week. We're continuing our coverage from this year's Milken Institute Global Conference held in Beverly Hills. Let's continue now with a look at how individual companies are navigating global economic volatility.
First up, Prudential Financial. It just released its quarterly results, beating expectations, and that's a big deal after the company missed expectations in 5 of the past 8 quarters.
Yeah, it was a change in trend. Prudential Financial, by the way, manages about $1.5 trillion in assets, so definitely a bellwether in the financial services environment. Andy Sullivan is the company's CEO. He joined us at the Milken Global Conference.
The underlying fundamentals were strong in the quarter, but that said, the reason I said what I said is we have so much more opportunity as a firm. When I look at our underlying capabilities, our people, our brand, and then the long-term tailwinds that our business mix positions us for, retirement and private credit,
right?
We can do more and we can deliver more for our stakeholders.
You did say on the call and you told Bloomberg, we've deployed capital as a company and not produced the return that we promised and communicated on public calls to our shareholders. That must change. How do you get there, and how long does it take you to kind of consistently provide the earnings picture that you'd like to present to investors?
Yeah, well, so there's 2 sides to this, right? There's the organic side and then there's the inorganic side. On the organic side, I'm a big believer. You say what you're going to do. You have an expected return level for the organic capital we deploy, and then it's about executing and executing well. A lot of that is about focus and making sure we're not spread too thinly as a company.
Where were you spread too thinly, Andy?
We were in, so over the past 5 years, we've exited a number of international markets. We now have a portfolio of, we're in the markets we want to be in. We're in the largest retirement, insurance, and asset management markets in the world. But we were in too many markets and we were subscale. And unfortunately, you can look at that and say, well, that's not a big deal. There's not that much capital deployed, but it's a management focus issue.
Right.
So it's funny, I mean, you bring that up. And prior to your being named CEO, I know there was a lot of talk at Prudential about leaning deeper into that with regards to the potential for retirement income to be a major growth driver. Is that still the case under your leadership?
Oh, absolutely. It's probably our best growth driver in the company. Whether you're talking about in the United States where we're at, we call peak 65, where 11,000 people are retiring every single day. A lot of work has been done on accumulation in the U.S. market, but not as much work on how to help people with protected income and decumulation. That's why I think you see this convergence of asset management and insurance, in particular in the annuity space, because there's such an opportunity, there's such a large gap in the market. But it's not just a U.S. issue. We're a major insurer in Japan. Obviously, with the aging demographic there and the fact that those citizens have almost most of their assets in the banks, they need the exact same help.
With regards to the relationship you have with the pension funds and these and the deals that you make with them, are they offloading the risk to Prudential? Are you absorbing that risk?
So we're actually a primary writer of the annuities product. You may be referring to we've expanded our capabilities with a reinsurance capability. Really what that's about is we need to bring additional capital to the space. If you're just looking at the mutual insurers or the public insurers, there's not enough capital to back the liabilities that really need to be put into the market to provide that level of protected income. So a lot of what you see is about bringing capital into the space.
I want to ask you about your asset management business, PGIM in particular. You guys reported net inflows of about $4.3 billion in the first quarter. We're now fairly into the second quarter. How are things looking right now?
Well, I will say that the volatility has an effect, right? When you have policy uncertainty and it creates volatility, business decision makers and individuals start to slow up on their decision making. We saw that in the month of March, and we've seen that continue into the second quarter. From an institutional number of transactions perspective, so we're the third largest real estate company in the world. We were on this nice trajectory of recovering from the lows of real estate, but what we saw in March and into the second quarter is a slowdown now in transactions.
How long do you expect that to continue? And I know it is based on, we're all like the trillion-dollar question in terms of what we expect. Do you feel like things are settling down in terms of what we are hearing, the cues from the White House?
Well, I would say, from the conversation this morning with the Treasury Secretary, it is about when do we see these first tariff deals come into place. I'm not going to be able or here to predict when that is, but what we're hearing from our clients is they want to stay invested and they would want to stay leaned in. So whether that's months or quarters is hard to say.
That was Andy Sullivan, CEO of Prudential Financial.
Another company we were able to highlight at Milken this year is jet manufacturer Bombardier. The company posting guidance for 2025 again, indicating it can navigate through an uncertain economic environment. Romain and I caught up with the company's CEO, Eric Martel.
We've been here many years, actually. At Milken, we're doing this every year. We have a lot of our customer here, so it's an opportunity to have conversation with our customer. And so this is a great conference. There's a lot of interesting topic, I would say, we discuss these days. So we are happy to be here again for, I don't know how many times, stop counting.
Well, but what's great about talking to someone like you are someone who's really leveraged the supply chain across North America. And I'm curious, what are some of the lessons that you've learned from building that out that maybe you could share with other folks who are looking at, maybe I've got to do it, but it looks like it's just insurmountable?
I think in the early days of COVID, I would probably talk about fall 2020, we've made a very different decision at Bombardier. Instead of cutting people in supply chain, we added people, which was very different than the normal crowd. So I think that's what explained probably our ability to better forecast over the last couple of years, the number of airplanes we're delivered. So we have a very proactive approach, trying to see problems coming up like 18 months before they come so that you have time to sort them out. So it's been serving us pretty well. We're not perfect. We still have things sometimes that come out at the last minute. But so far, we've worked very diligently with our supplier base, which we have 5,000 supplier total, so which brings some complexity. But it's been going fairly well so far.
What's demand like? And let's start with the airlines first, that side of the business, because several of the big carriers, not necessarily the ones that use Bombardier jets, have basically said, look, things are going to be a little slower. than what we thought in terms of passenger travel. Have you seen any real ripple effect of that down to the types of jets that you sell?
Yeah. So as you said, we're focused on business aviation, so we just do private jet. Mm-hmm. But clearly, COVID was an accelerator for our environment. A lot of people, go back to 2020, in the summer of 2020, a lot of commercial flights were grounded, a lot of liaison did not happen. So the people who could afford it maybe didn't buy their own airplane, but they bought shares, from fleet operator and hours, and started to fly private. So we've seen an explosion of hours. If I look at the hours our jets were flying in 2019, today it's about 40% higher. And it's the new normal. It's been going up another 3% since last year. So clearly our business, it created a new normal of activity. And since then, it's been just growing, keep growing.
So what ails the airlines does not necessarily affect your company, your customers in the same way? They're
we have a different customer base. The people that buy our product are chairman, CEO. Either they have a company in the U.S., so they will use a smaller jet, or they have a global company. And I don't know, they're in New York today, they need to be in Singapore next day and come back to Dubai 3 days later. So these guys, it's a very efficient tool for them. They would never be able to do that flying commercial.
Can I ask you about the new 8000 jet? Is that going to enter service this year?
It is, actually. So we stopped flying the airplane now. We flew the airplane. We have all the testing done. Now we're working with the authorities, on engines, with GE, because, most of our customer base, supplier base, is in the U.S., 2,800 supplier in the U.S., and we are working with all these guys to get the 8000 certified by year end. We're pretty excited because this is going to be the new flagship of the industry, the biggest airplane in business aviation that flies further, faster, higher than anything else that exists today.
Wait, so I'm just curious, going back to business jet orders and companies and their environment, are you seeing orders fall off from companies at all that as a sign of holding back?
Yeah, Q1.
Because it is something that, I think we're looking for different indicators, when it comes to what's the health of the overall outlook in a world where, certainly at Milken, everybody keeps talking about uncertainty.
Yeah. You know what? It was very similar in the first quarter to what we saw 2 years ago when we had the bank crisis. About 3-4 weeks of uncertainty. And, we assembled the airplane in Canada, so there was question about the tariff, how is it going to work? There was a bit of lack of clarity. But as things clarified around the quarter, we've seen things re-engaging normally. So right now we have quite a bit of activity, here this week, but also, worldwide. I would say Middle East is very strong. APAC remains pretty strong too. Europe maybe a bit more slow, but the U.S. is doing fairly well.
Eric, one thing I want to ask you, President Trump meeting with the Prime Minister of Canada, Mark Carney, USMCA came up several times, and the Prime Minister stressing, the importance of that agreement. I am curious what kinds of opportunities that integration specifically has provided you guys.
Yeah. I think if
is it a good trade agreement for you?
It is a good trade agreement already, and I think I understand exactly the President of the United States wants to revisit that, and I think our government will be fine doing so. I think it's been a huge leverage for the three countries that are part of the agreement over the years. Actually, aerospace, even before NAFTA, in 1979, we had a free trade agreement worldwide. And I think there's in aerospace, of course, we assemble, we're being perceived as a Canadian company, which I'm extremely proud of, but we are really a North American company. I have 2,800 suppliers in the U.S., 2,800, and many in Mexico also, many in Canada. So overall, we've done extremely well altogether. It's a great business, but it's important. This is not something we can change overnight. It's going to have to take time if we want to move things around, bring back work into the U.S., which we still have a lot today. And it's interesting, despite being Canadian today, I have if you take the Global 7500 today, 42% of all the cost of the airplane is U.S. So because we do build a wing, which is one of the most important components here in Dallas, and we also buy the engines from GE in Lafayette.
Right, exactly. So if he wants to buy, what is it, the new 800?
It's 8,000, Carol.
8,000.
It's out of my price range, but I'm sure he's got some other more eligible customers lined up.
We can have a discussion after,
Maybe one day. I can dream. Eric, it's been a pleasure.
Thank you. It's been a pleasure too. Thanks to both of you.
That was Eric Martel, CEO at Bombardier.
Still ahead on Bloomberg Businessweek, the debt ceiling so-called X date kicked down the road, but for how long? Plus, we tackle the housing affordability crisis in the United States with a former mayor of Baltimore. Much more to come. From Milken, this is Bloomberg.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
I'm Carol Massar along with Romaine Bostic, a special version of Bloomberg Businessweek, our weekend edition this week, where we bring you highlights from our coverage of the Milken Institute's global conference held annually in Beverly Hills.
This past week, Treasury Secretary Scott Bessent testified before a House Appropriations hearing in Washington and said the Treasury is on, quote, the warning track toward exhausting its capacity to stay within the federal debt limit.
We should point out the Treasury Secretary also here at Milken making an array of comments about the U.S. Meanwhile, the head of the nonpartisan Congressional Budget Office suggests the Treasury has a few more months before exhausting its cash to keep paying its obligations in full and on time, thereby avoiding a potential default.
For more on that potential X date, we spoke to CBO Director Philip Swagel.
We still have it as late in the summer, into August, into September. Of course, it's possible that it can come forward depending on the continued revenue, especially in June. But for now, we're comfortable with our later date that Congress has time to act on it.
The revenue you're seeing coming in, at least in the most recent month, you're encouraged by that?
It was tracking reasonably well with our expectation. And this is the projections that we made back in January and February, that the revenues are still in line with that.
One thing I want to ask you in terms of real deficit reduction, because one of the things, I just did a global real estate panel, and the thing that they are most concerned about seemed to be the growing U.S. deficit. What real constructive work are we doing to really reduce the deficit, and what kind of pain might it impose on U.S. citizens?
Yeah, I've seen the Treasury Secretary talk about that. He was here at the Milken conference this morning talking about it. He is writing in the Wall Street Journal about it. And so I know he's focused on it. I know the administration is focused on it. And it's important, it's necessary. It doesn't have to be done immediately, but that, since this should be reassuring to the American people.
Why do you say it doesn't have to be done immediately? Many would have said 10 years ago, 15 years ago, we would have had this conversation and talked about kicking the can down the road. And here we are again. Why is it not an immediate problem? You're exactly right that in the past, there's been an urgency and then the lack of follow through, the lack of action. And that's part of my message, is that we do as a country have time because the rest of the world still sees us as a country that's stable, that's secure, that's growing. There's lots of volatility in the US and the policy environment now, and that's a negative. We still have the trust of global investors, and that's what gives us time.
How confident, though, are you right now in your economic projections? The Treasury Secretary specifically called out the CBO's GDP projections of 2%-ish or so. He's saying, in his view, that number should be closer to 3%. What's the gap? Why does that gap exist?
Okay, the gap is understandable because what CBO is doing is projecting the economy under current law. And what the Treasury Secretary is doing is completely appropriate. He's saying, with the president's agenda, he says, we, the administration, have a pro-growth agenda. He thinks that will be successful, and of course, all Americans hope it will be, and that will boost economic growth. And if it does, well, then that will be good for everyone. We're just looking at different things. So we're looking at what was the economic trajectory before the president's agenda.
There's a balance, though, as well. So we don't quite know which policies will become law or become real. I know that's going to take some time. But we do know the contours of this administration. A crackdown on immigration, which immigration, of course, to a certain extent has been a net positive, at least on aggregate GDP growth in this country. There's also a lot of issues when it comes to the IRA, which the Trump administration is trying to scale back. When do you factor those impacts in and the potential drag on growth?
You're putting your finger exactly in the important question, is that all of the changes happening, both the executive actions and then the legislation being considered by the Congress, how will those impact the economy? And so the executive action you mentioned on immigration, that affects the labor force, that affects the economy, it affects the federal budget. We are tracking that. It's still a little bit too soon to know what is the long-term impact of that. Is the decline in immigration temporary, or is it a long-term factor? And that's the kind of thing we are tracking. Our next update will be late spring, early summer, and we will build in that, the IRA, all the other changes into that next update.
Many economists, though, would, in terms of immigration, the importance in terms of feeding the labor market, providing a younger population, they point to Japan, they point to places like South Korea where folks are not having babies anymore, and even in America in terms of the small families that people are having. So I understand what you're saying, but a lot of economists have done the research for years about the importance of immigration in terms of the health of economic growth for a nation.
It's what makes immigration a difficult issue is that it's both an economic issue, and you pointed to the key economic factors, but it's a social issue, it's a political issue. People worry about crime and safety and local communities, and it builds together all those things. And then there's high-skilled immigration and low-skilled immigration, and those are connected as well in the policy space. So that's what makes it a difficult thing, is because it brings together so many cross-currents in our society.
I am curious what you guys think about the outlook. We're in earnings season, and we've been reporting on it, and you do have companies come out with two scenarios because they see it as one, potentially where we are no growth or in a recession, and so it doesn't look so good. We have another where things look pretty normal, and we're back to American exceptionalism. Tell us about the scenarios that you are planning for, because that's very different in terms of the U.S. government, what the fiscal picture looks like.
No, you're right. And we at CBO have the same dilemma as the companies to try to figure out which trajectory are we going on. And of course, there's a spectrum between them. We suspect the volatility of the last month will lead to slower business investment, reduce capital inflows, reduce foreign investment in the U.S. That will tend to have a negative effect on growth. On the other hand, if there are trade deals, if there's changes in regulation that are pro-growth, that will go in the other direction. And that's what we're looking at, is to try to figure out the balance between the sort of the downward pressures, the volatility especially, and the upward of the president's agenda.
Is there a balance, or are you leaning one way or the other based on what we've seen so far?
It's just too soon, because there's a sense in which we have all the volatility, we have all the negative parts, and now we're waiting on the positive. And that, I'll just, we posted our first cost estimate for the reconciliation bill of the House Armed Services Committee. So there's lots more to come as the different committees in the House do their work, and we will analyze it. But it just gives you an indication there's a lot more coming. There's a lot of legislative activity, and that's the part that's still to be written.
That was CBO Director Philip Swagel.
Now, as we get ready to wrap up our coverage from the 28th Annual Milken Institute Global Conference held in Beverly Hills this past week, got one more conversation we wanted to bring to you on something that is very relevant and has hit the nerves of many across the country, and that is the lack of affordable housing. It's been an issue we've talked about, though, for a long, long time.
Median home prices now approaching more than 6 times the U.S. median income. And if you're renting, you're spending more than a third of your income on rent alone.
For more on what the government as well as what the private sector can do to help alleviate the housing crisis, we spoke with Stephanie Rawlings-Blake, Airbnb Housing Council Chair and the former mayor of Baltimore.
One of the things that I took out of the panel that we had is that it's going to take all of us, right? Airbnb understands, for example, that they're not the cause of the housing supply shortage, but they can be a part of the solution. As a mayor, I knew that I didn't cause it, but I had to be a part of the solution. And some of the developers and private equity folks that were on the panel, they have to understand that they have to be a part of the solution as well. So it's an all hands on deck. We talked on the panel that we're short in this country over 5 million homes. And we're not going to close that gap by doing what we did yesterday or a decade ago. We have to think critically and with more innovation around how to build more, how to build faster, and how to build better.
How did the city, though, grapple with economic growth, similar to what Baltimore went through, where you had this huge resurgence, companies coming back, people moving back to the city? Of course, that also drives up, typically, real estate prices as people look for homes. So there's a balance, right? You want to, reap the fruits of getting all those people back into your city, but at the same time, you don't want to shut everyone out who maybe isn't at a certain income level. Where's the balance?
So I always look for the win-win. And when you talk about bringing people in, that's always a good thing. But in Baltimore, like many cities, we have a circuit breaker, meaning the value of your home year over year could go up 100%, but your property tax will only go up a fraction. And that allows people to stay in their homes and reap the benefit of wealth creation through their home. But There are also things like repurposing vacant homes. I think we need to think differently about vacant homes. Yes, they're a blight, but they're also an opportunity. When home ownership is so far out of reach for many of America's young people, we can look to rebuild and these vacant homes as a way, because the infrastructure is already there, right? Cities like Baltimore were built for, over 1 million people. So that infrastructure is there, the people aren't there. So how do we look at those vacant homes as opportunities for families and young people to become homeowners?
Stephanie, I love that you went there, because I think people are like, just build homes, build the 5 million homes. It's not just about building them anywhere. It's about building them where people need them. And they tend to be cities which tend to be expensive. So as soon as the build happens, it's often expensive. How do we fix that? How do we get developers, politicians, everyone to say, let's build where the housing is needed and let's make sure we make it affordable? How do we do that?
So cities like Baltimore are incentivizing affordable housing, incentivizing repurposing vacant homes.
Right.
That was one of the projects that I started as mayor, my Vacants to Value program that our current mayor has taken on and made it his own. So we need to do things like that, where we're creating incentives like down payment assistance. The president of Johns Hopkins is speaking here at Milken. They give employees like match for match. Like they're giving their employees thousands of dollars in down payment assistance if they move around the university. So things like that. And we have to look for innovative ways to promote financing of affordable housing as well.
That was Stephanie Rawlings-Blake, Airbnb Housing Council Chair and the former mayor of Baltimore.
And that wraps up our special weekend edition of Bloomberg Businessweek from Bloomberg Radio at the Milken Institute Global Conference this past week. You can catch all the conversations from the event on the Bloomberg and at Bloomberg.com. Thank you so much for joining us.
Be sure to tune into Bloomberg Businessweek Daily, Monday through Friday, starting at 2 p.m. Wall Street time on Bloomberg TV, Bloomberg Radio, and on Sirius XM Channel 121. And you can listen to us on Apple CarPlay and Android Auto. It's free in the Apple App Store or on Google Play.
You can also watch our daily broadcast on YouTube. Just search Bloomberg Global News. We're simulcast on Bloomberg Originals, available at Bloomberg.com/originals, and streaming platforms including Roku, Amazon Fire TV, Samsung TV Plus, and more.
Find our Bloomberg Businessweek daily podcasts at Bloomberg.com, Apple, or wherever you get your podcasts. The latest edition of the magazine, it's available on newsstands now at Bloomberg.com and always on the Bloomberg terminal. I'm Romaine Boston.
And I'm Carol Massar. Thanks for listening and watching, everybody. Have a good and safe weekend. Stay with us. Today's top stories and global business headlines are coming up.